Central bank independence is a description of the legal authority of central banks to make decisions on monetary policy with little interference by the government in power. The rationale being, an independent central bank can prevent the government in power from using monetary policy in ways that may appear beneficial in the short run, but can harm the economy in the long run. Expansionary monetary policy can result in short-term gains at the expense of long-term pains. The gains result in higher inflation, will temporarily increase GDP, and reduction in unemployment in the short run. The pains result in higher inflation rates in the long run. This figure illustrates the gain then pain scenario associated with an expansionary monetary policy. An expansionary monetary policy will shift the 80 curve to the right. The intersection between the aggregate demand curve and the short-run IA curve determines the inflation rate and the real GDP in the short run. Real GDP increases above the potential GDP as interest rates fall and investments rise. However, as firms are able to adjust their prices, inflation rises, and the real GDP drops back to the potential GDP. The Phillips curve is an observation that inflation and unemployment are negatively correlated. The Phillips curve is named after A.W. Phillips, an economist who first documented this correlation in British data from 1861 to 1957. Here is an illustration of a replica of the Phillips curve. The Phillips curve was widely used in the 1960s and 1970s to justify expansionary monetary policy. People argued that higher inflation would lead to lower unemployment. There are some evidence against using the Phillips curve. Evidence number one, the average unemployment rate in the 60s, 70s, 80s, and 90s was constant, yet inflation was high in the 1960s and 70s and low in the 80s and 90s. The second piece of evidence against the Phillips curve is the low unemployment rate in the 1990s did not result in high inflation. The political business cycle is a business cycle caused by politicians' use of economic policy just before an election. Incumbents would find it in their best interest to lower unemployment and raise GDP just before an election, then slow the economy down after. One disadvantage of central bank independence is that it can be taken too far. For example, a central bank may be so focused in fighting inflation that it may end up leading an economy deeper into a recession. Independent or not, central banks need to be held accountable for their actions. For example, to keep the Central Bank of New Zealand in check, an explicit agreement is made that if inflation goals are not met, the head of the central bank is fired. Money demand is a relationship between the nominal interest rate and the quantity of money that people are willing to hold at any given nominal interest rate. The money demand function is a downward sloping line, illustrated here. A downward sloping money demand function implies that an increase in the nominal interest rate will decrease a person's holding for money, while a decrease in the nominal interest rate will increase a person's holding for money. Why hold less money when interest rates increase? The interest rate is the opportunity cost of holding on to money. Higher interest rates will make it more costly to hold on to money, because money bears its holders no interest. Using the money demand curve, the Fed can determine the quantity of money associated at a nominal interest rate. Since the Fed controls the money supply, the Fed can then target an interest rate simply by increasing or decreasing the money supply in the market, illustrated in this figure. An increase in the money supply will shift the money supply curve to the right and will cause the interest rate to decrease. On the other hand, a decrease in money supply will cause it to intersect with money demand at a higher interest rate. The discount rate is the interest rate that the Fed charges commercial banks when they borrow from the Fed. Lower discount rates make it cheaper to borrow from the Fed. However, the Fed usually does not let the discount rate depart too much from the federal funds rate. The reserve requirement is the minimum fraction of deposits that banks must keep at reserves. Higher reserve requirements will make a bank demand more reserves and will cause the federal funds rate to rise. Lower reserve requirements will cause the federal funds rate to fall. Exchange rate is the rate at which one country's currency is exchanged for another country's currency. Flexible exchange rate policy is a policy in which exchange rates are determined in foreign exchange markets and governments do not agree to fix them, which is to keep them at a certain value. A fixed exchange rate policy is a policy in which a country maintains a fixed value of its currency in terms of other currencies. Between the end of World War II and the early 1970s, the United States and most developed countries were part of a fixed exchange rate system called the Bretton Woods system. More recently, 12 countries, Austria, Belgium, Finland, France, Germany, Greece, Ireland, Italy, Luxembourg, the Netherlands, Portugal, and Spain, permanently fixed their exchange rates by forming a monetary union with a single currency, the euro. Countries in the European Union, but not using the euro, include the UK, Denmark, and Sweden. Cyprus, Estonia, Latvia, Lithuania, Malta, Slovenia, and Slovakia are new EU members that are scheduled to use the euro. The euro was established by the European Union through provisions in the Maastricht Treaty of 1992. The exchange rates were set on January 1st, 1999, and the physical currency was introduced on January 1st of 2002. In order to participate in the new currency, a country must achieve rigid requirements such as a budget deficit of less than 3% of GDP, low inflation and interest rates similar to those of low inflation countries, and a debt to GDP ratio of less than 60%. Greece failed to meet their criteria originally in 1999, but was permitted to join in January of 2001. If two countries have a fixed exchange rate and people are free to move funds back and forth between countries, then the interest rates between these two countries must move together. This scenario would be critical if one country experiences inflation while the other a recession. Raising the interest rates in the inflation country will push the recession country deeper into a recession. A real-life example of the interest rate effects of a fixed exchange rate happened in Britain in 1992, while Britain was still part of the European exchange rate mechanism. High inflation in Germany forced Germany to raise interest rates. Unfortunately, Britain was facing dire economic times, and higher interest rates only worsened this situation. Britain exited the ERM rather than allow its economy to go deeper into recession. Exchange market intervention is the purchases of foreign currency by a government with the intention to affect the exchange rate. There are three ways to intervene in the exchange rate market. Number one, buying and selling of foreign currency by the central bank. Number two, raising interest rates to keep investors in the country. And number three, preventing funds from flowing between countries. Reasons why some countries have fixed exchange rate systems, mainly there are two. Main reason number one, exchange rate volatility interferes with trade. And reason number two, some countries have a history of poor monetary policy. A goal of fixing exchange rates in these cases is to adopt the good monetary policy of a country whose central bank has a history of good policy.